mistake number 5. Buy when everybody's greedy and sell when everybody's fearful. This is a rough diagram of how the stock market moves. It goes up and down, but over the long term, we have seen that the stock market has always gone up. And the mistake that so many people make is that they come in and they start buying here, when all the news is talking about how markets are going up and everybody is getting so rich, and you don't want to miss this opportunity. So you come in and buy because your Uber driver is getting rich, your co-worker is making a whole lot of money, and that silly neighbor who should not be having all that money is making a lot of money. So you come in and buy, and then you start to hear the news about how the markets are tanking, everybody's losing money, it looks like the world is going to end, everybody's freaking out. So now you come in and sell. So you're buying high and selling low, and you are the reason why so many people are getting rich in the market, and I want you to start to flip that. And what I mean by that is, when you see these downturns, don't use them as a time to freak out. Use them as an opportunity to buy. Because we saw a common denominator happen in 2022, 2020, and in 2008. Each one of these things had a market downturn. In 2022, we saw the stock market fall by around 20%. In 2020, we saw the stock market fall by around 34% at the fastest rate we've ever seen markets fall in the history of time. And in 2008, we saw the housing market crash and we saw the stock market tumble. Well, in each one of those things, some people lost a lot of money and some people became incredibly wealthy. The people that lost a lot of money were either the people that had too much debt, or they got scared, or they didn't know what was going on. The people that made a lot of money were people that had cash reserves and were able to come in at the bottom. People that bought in 2022 were buying stocks at a discounted price. People that bought stocks in 2020 were buying stocks at a cheap price. And after the 2008 crash, people that were buying stocks and real estate during that crash were able to become incredibly wealthy, because you have to have the right time to understand that these things create opportunity when you understand how markets work, because the reality is markets go up, markets go down, but over the long term, we've always seen markets go up. So if you are a long-term investor, not a trader, understand the psychology. That way you don't have to be the person that's making other people rich. You can be the person that's using these downturns as an opportunity to find opportunities to build wealth for yourself and your family. And this brings me to mistake number 6, is you have a short-term mindset instead of an investor's mindset. The technical definition of an investment according to the tax code is somebody who's investing their money into an asset like the stock market for at least 1 year or longer. So holding a stock for 1 year plus, but really the best investors are holding on to their investments for years, if not decades, because you believe in the long-term future of that asset, of that stock. And if we just take a look at the stock market, if we take a look at over the last 1 year, you'll see how volatile it looks. Over the last 5 years, it starts to look a little bit less volatile. And as you zoom out even more, you can start to see, oh, it doesn't look as volatile. But the mistake that so many people make when they invest their money in the stock market is they buy a stock in the morning, and then by the afternoon, they've already checked the price of the stock 16 times. You check it again and again and again, because now you want to make sure that the stock is only going up in price. The next morning, you check it, you check it, you check it. And that's what starts to create that anxiety and fear, because you want to know the price of that stock at every moment of every day. But think of it this way: if you went out and bought a house tomorrow in the morning, would you be checking Zillow to see what the Z estimate is after lunch or in the evening? No, because you know that this is something you want to buy for the long term. When you buy a stock as a long-term investor, why are you so concerned about the day-to-day price swings? What you want to focus on is the actual asset, the actual value. There's going to be a lot of movement in the stock market, and that can be great for some people, but for most people who don't know how to control their emotions, they turn an investment into a short-term trade because they start to panic as soon as the thing starts to go down. But remember, you don't actually lose any money unless you sell or if the stock goes bankrupt. And so if the stock goes down, you're not losing money unless you actually sell. Well, now you've just lost money, and that's why you got to understand the game as an investor is to own the asset for the long term. And finally is number 7, not factoring in fees. If you have money in a 401k, if you have money in a mutual fund, if you have money in an ETF or an index fund, if you have money with a financial advisor, you have to pay a fee. This fee can be called assets under management. It could be called an expense ratio. But what this fee is how much money you are paying every single year for having your money into this asset. Let me show you why this is so important for you to consider. If you invest your money $1,000 a month, you can get a 10% return on your money, and you are investing your money yourself and you don't have to pay any fees. Well, over 40 years, your investments, your $1,000 a month, are going to grow to right around $5.8 million. Not bad. But now let's assume that you put your money into some low-cost fund and you're going to pay a 0.2% fee. You're still investing the same $1,000 a month, the same 10% a year, and you do this for 40 years. But now instead of having $5.8 million, you are going to have $5.5 million, which means, yes, you paid out around $300,000 in fees over the course of 40 years. So yes, it was a small little 0.2% fee, but there is a cost to that fee because your fees are also compounding while your money is working to compound for every dollar you invest and for every dollar of profit that you gain. But these fees can be worth it when you are getting good returns and when it helps you actually invest your money, because some people can't do this. Some people need those funds or advisors to help them with that. If you're working with mutual funds or financial advisors that are going to charge you a little bit more, it might be a 1.5% fee. Now, if you invest the same $1,000 a month, 10% a year, you're paying a 1.5% fee over 40 years. Well, now you're not going to have $5.8 million. You're not going to have $5.5 million. You are going to have closer to $3.8 million, which means, yes, your advisor is going to take $2 million over the course of those 40 years. For some people, this will be worth it because if you don't do this, you're not going to be investing your money. So yes, this is better than having nothing, but you want to understand the cost. That way now when you're thinking about how you invest your money, you can also think about fees, because a small adjustment in fees can result in hundreds of thousands of dollars or millions of dollars in more gains for you. The average person doesn't even know that they're paying these fees, which is why it's so important for you to understand the power of small incremental changes in the growth of your portfolio, because small changes can add up to big dollars over the course of your investing career. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.